We have already seen the first observable symptom of this break. In early March, Goldman Sachs recorded a multi-strat Mageddon, a 4-standard deviation momentum drawdown across multi-strategy funds. The bond market has broken the standard duration playbook, rendering traditional risk parity models ineffective. All of these forces, the oil shock, the leverage vulnerability, and the bond market repricing, intersect at the April 28-29 FOMC meeting. The institution is facing political paralysis. April is Jerome Powell's last scheduled meeting as chairman, while his presumed successor's confirmation remains blocked in the Senate. Markets are attempting to price in the Warsh doctrine, a preference for medium-term frameworks over immediate data dependence. This succession uncertainty removes reliable forward guidance. The current Fed consensus is operating on a razor-thin margin. The March baseline median projected just one single rate cut for all of 2026. This dot plot grid illustrates a catastrophic binary risk. If a single Fed participant shifts their projection to hold through 2026, the entire median crashes to 0 cuts. That single shift triggers an immediate repricing of the yield curve's front end. The Fed is boxed into a policy trap. Cutting rates exacerbates the term premium, while holding rates detonates the over-leveraged hedge fund parity trades. An unresolved oil shock meeting a zero-cut Fed policy leads to extreme institutional redemption pressure. Forced liquidations fail because funding structures break before prime brokers can even place the sell orders. This circular flowchart maps the Office of Financial Research's model of a repo cascade. Margin requirements rise, forcing the fund to sell bonds. That selling widens the basis, and that basis move instantly increases margin requirements again, feeding the loop. Inside this loop, internal VAR limits act as binding constraints. They force algorithmic unwinds even when raw repo financing appears available from the banks. Recall the zero haircut data. Because the fund's cash is already pre-pledged as collateral, the fund possesses zero actual defense against the first margin call. Surviving a redemption wave is a collateral sequencing problem. Survival requires converting overnight repo to 90-day term financing before the stress event materializes. Once the cascade starts, term financing is repriced or unavailable.